Your brain is your biggest investing enemy. Behavioral finance is the science of how psychology drives market decisions and destroys returns. Fear, greed, loss aversion, herd mentality, anchoring. These biases don't just affect beginners. They affect Nobel Prize winners, hedge fund managers, everyone. Understanding them is the difference between building wealth and watching it disappear. Loss aversion is the most powerful force in investing psychology. Losing $100 feels twice as painful as gaining $100 feels good. This asymmetry was proven by Kahneman and Tversky in 1979 and explains why investors hold losing stocks too long, hoping to avoid realizing the loss, while selling winning stocks too early just to lock in the gain. It's called the disposition effect, and it costs investors roughly 0.5% of returns per year on average. Anchoring bias happens when your brain fixates on an irrelevant reference point. You bought a stock at $100. It drops to $60. You anchor to 100 as the real value and refuse to sell, even when every fundamental says 60 is now overpriced. Or you see a stock that was $200 trading at 90, and it feels cheap because of where it came from. Price history is not valuation. The stock doesn't know where it's been. Overconfidence bias affects 90% of investors. Studies show most people believe they are above average investors, but 93% of active traders underperform the market index over 10 years. The most dangerous version is the illusion of control. You feel that because you researched a stock, you understand it better than the market does. In a market with 10 million participants and AI-driven analysis, your edge is almost certainly smaller than you think. Herd mentality turns individual decisions into market crashes. When everyone else is buying meme stocks or crypto, the pain of missing out overrides rational analysis. FOMO, fear of missing out, is a measurable cognitive bias. It triggers the same dopamine pathways as social approval. Bubbles form because hurting feels rational in the moment. When you're making the same investment decision as your taxi driver and your barber, that is your signal to be very cautious. Mental accounting is why you treat money differently depending on where it came from. You spend a bonus or tax refund freely because it feels like house money. You won't sell a losing stock in a taxable account because realizing the loss makes it real. But money is fungible. A dollar is a dollar regardless of its source. Warren Buffett calls mental accounting one of the greatest hidden destroyers of long-term wealth. Confirmation bias means you search for information that confirms what you already believe and ignore the rest. You buy a stock, then spend the next 6 months reading every bullish article you can find while dismissing bearish analysis as uninformed. The solution is adversarial research. For every investment thesis, actively build the strongest possible case against it. If you cannot articulate why you are wrong, your analysis is not complete. Beating behavioral biases requires systems, not willpower. Create an investment policy statement before you invest. Write down why you're buying, what price would prove you wrong, and when you'll review it. Use automatic contributions to remove emotion. Rebalance on a calendar schedule, not when you're scared. The investors who consistently beat the market aren't smarter. They've built processes that protect them from themselves. Your psychology is your biggest alpha source once you learn to control it.